Hello everyone, welcome to another video of Accountancy for You. So today we'll be continuing with current ratios from J.S. Gravall's Analysis of Financial Statements, textbook for grade 12, and we'll be doing question 5 today. So let's get started. Question 5 states that working capital is 6 lakh, total debt is 27 lakh, non-current liabilities 24 lakh, and they've asked us for the current ratio. So let's just do a small recap about working capital. We discussed it in the previous video. Working capital is the capital of a business used in its day-to-day operations. And this is very important. Its working capital is equal to current assets minus current liabilities. Right, current assets of a firm minus the current liabilities of the firm give us the capital it uses in its day-to-day operations. So I hope that point's clear. Next, they've given us total debt to be 27 lakhs. Now, total debt is not just the entire amount of debt that we owe, that the company owes to an external liability. Total debt, well, let's take a look at the balance sheet. So the balance sheet has the liability side and the asset side as we discussed earlier. And on the liability side, there is equity, also known as shareholders' funds, debt, which is also known as non-current liability or long-term liabilities, and our current liability, which we've been dealing with so far. And on the asset side, we have fixed assets, non-current investments, and current assets. Now we already discussed that current assets minus current liability gives us working capital. Right. But we should also know that our debt, the company's debt, or the non-current liability or the long-term liability, plus its current liability, together forms total debt. So it's not just the entire amount of debt, but it is the debt plus the current liability. So I hope that point's clear as well. Next, they've given us our non-current liabilities, which is the amount of debt, 24 lakhs. So current ratio is equal to current assets by current liabilities. Current liabilities. Now, have they given us any point directly? No, but they have given us a clear way to find it. Working capital is equal to current asset minus current liability. Then we know that total debt is equal to debt plus current liability. They've given total debt to be 27 lakhs, debt or non-current liabilities to be 24 lakhs, and thus this implies that our current liabilities is equal to our total debt minus our debt. Total debt minus our debt gives us current liability. Current liability is total debt minus debt. Right? So this is 27 lakhs minus 24 lakhs, 3 lakhs. Next, to find our current assets. Current assets, we know that current assets are equal to, well, from this equation, we can understand that current assets are equal to working capital plus current liabilities. So working capital plus current liabilities. Right. So this means current assets are equal to our working capital. They've given it to be 6 lakhs plus our current liabilities. We found out that it is 3 lakhs here, so 3 lakhs, which is equal to 9 lakhs. This implies that our ratio is equal to 9 lakhs by 3 lakhs, which gives us the ratio 3:1. And as I've mentioned in the previous videos, the ideal ratio for current ratio is 2:1. And here, since it's 3:1, it means that there's one idle fund for the company. So I hope you guys were able to follow that answer, and if you have any doubts, do mention in the comment section below. I will surely try to answer it. And don't forget to like, share, and subscribe. Thank you. See you in the next video of Accountancy for You.